Hello everyone, and once again welcome to the 100 most important topics for your prelims 2026. So all of you are joining the YouTube channel with regard to Drishti IAS, and as you all know that we have come up with 100 most important topics, and that is for your prelims 2026. So in the last video, you must have seen we discussed about the topics with regard to money and the concepts with regard to money, where M1, M2, M3, M4, the functions and all. Yes, the surprise question there was with regard to the sign, that is the currency sign which the Indian rupee has. I did ask you that who had coined this, or who was the individual who came up with this sign. Now the name of the individual, it's Uday Kumar. Okay, so the name of the individual, it is D. Uday Kumar. He is an individual from IIT Bombay, and the cabinet, it approved this particular symbol with regard to Indian currency. That is on 15th of July 2010. Okay, 15th of July 2010. So that was the surprise question for which I gave you the answer. Now today we are going to go a step forward with regard to the topic with regard to money itself. And today we will be talking about the money multiplier. We'll be also talking about the certain tools with regard to money, whether it is CRR, whether it is SLR or SDF or MSF, like that. And also we will be discussing about the monetary committee with regard to the it's a very important topic with regard to that. So the first thing which we have to do today is the money multiplier. Now, as you all know, when we talk about money multiplier, then here in this money multiplier, it is the CRR which is very important. And CRR is nothing else but it is the cash reserve ratio. Now, in 1 or 2 minutes, I am going to tell you what is that cash reserve ratio. But this CRR, it is set up by the RBI. And the RBI, when it set up the CRR, it results into two things. One is the fractional reserve banking, and the other one is the credit creation by the commercial banks. So two things are the result of the CRR which is set by the RBI. One is the fractional reserve banking, and the other one is the credit creation by the commercial banks. Now, when I talk about the CRR, then always the CRR, it is something which is related to the money which commercial banks, they hold with the RBI. So when we are talking about money multiplier, there is a word that is high powered money which comes into the topic. Now, what is this high powered money? High powered money, it's also referred as monetary base, and it is expressed as M0, or you can also express it as H. Now, when we define this high powered money, remember it, high powered money, it is nothing else but it is the total liability of the central bank, that is consisting of currency in circulation as well as the cash reserve which is held by the bank. So this high powered money, it is basically the total liability of the central bank, and that too with regard to the currency in circulation and the cash reserve which is held by the bank. And this high powered money, it basically acts as a foundation for the entire money supply. Now, why it acts as a foundation for the entire money supply? Because this high-powered money, it allows the commercial banks to create deposits. That is, they are trying to create deposits, that is through loans. That means whenever a commercial bank is extending loans, then the individual or the borrower to which the commercial bank is extending loan, the borrower has to open an account with the commercial bank. Now that is what is the creation of money. So that is how the money is being multiplied. So the role of high-powered money is very, very important. Now look at this entire table. What is this all money multiplier telling us? Now what is the very importance of this CRR? Now always, for example, take it like 100 rupees is the amount which was deposited in the bank, and the CRR or the reserve ratio, it is the reserve which has to be kept by the banks, that is 10% of the total deposits. That means if there is a 100 rupees deposit, then the 10 rupees goes to the reserve and the remaining 90 rupees is extended to by the banks, commercial banks, as loans. Now the individual who is taking loan, they have to open an account in the name of the borrower in that particular bank. So the bank, what it does, it deposits that 90 rupees which it had extended to the borrower as loan. Now the borrower takes out that 90 rupees or the borrower transfers that 90 rupees to an individual from whom he had lended. Now what happens? Now again a 90 rupees is added into the account deposit of the bank. So now with that 90 rupees, how much can the bank extend? 90% of 90 rupees, that is 81 rupees, and the remaining 9 rupees is the reserve. The remaining 9 rupees is what? The reserve. Now when we are talking about money multiplier, then always remember money multiplier depends upon 1 upon R. That is 1 upon R means 1 upon 10%. So 10% means 100 upon 10, that is 10 times the initial deposit. What did I say? 10 times the initial deposit. So what was the initial deposit? It was 100 rupees, and 10 times of 100 rupees is what? 1000 rupees. So the 100 rupees which was deposited in the bank in round 1, that multiplied into how much? It multiplied into 1000 rupees. Now here I have written the total money. And here the total money is M3. Now do you remember what M3 included? M3 included coins and currencies, M3 included demand deposits with the bank, and M3 included the time deposits with the bank. It did not include anything with the post office. So this 1000 rupees is the M3. Now what is the loan? 90%. Though 90% of 1000 is 900. And what is the reserve? The reserve is what? 100 rupees. So this is what is referred as money multiplier. So that means when we talk about the RBI is the issuer of currency. It never creates the currency. But the creation of currency or the creation of money, it is always done by the commercial banks. But how the commercial banks will do the money creation, that all depends upon the CRR. So that's why the CRR is set by the RBI, and the RBI, when it sets the CRR, it results into two things: fractional reserve banking as well as credit creation by the commercial banks. Now if you want to understand, what you have to do, just pause the video. I'll move away from the video. You can pause the video and you can look at the things which are written here. I have given you the formula of money multiplier. It is the stock of total money divided by the stock of high-powered money. Stock of total money was 1000 rupees. High-powered money is 10 rupees. So that means the total liability which is on the RBI, it is 100 rupees. So what is the money multiplier? 10. So that is what. And if you want to calculate here, for example, if you have to calculate what is this total deposits, then nothing else. Whenever we are calculating the total deposits, then total deposits is equals to primary deposit plus 1 upon CRR or 1 upon reserve. So the primary deficit was what? 100 rupees, and this divided by R is what? Multiplied by 1 upon RRR. So that becomes as 1000. So total deposits, if you only want to find this total deposit, so what you have to do, the primary deposit, that is the high powered money, multiplied by 1 upon R. And 1 upon R is what? It is the, reserve ratio. And this reserve ratio, that is the rate, that is 1 upon R, 1 upon LRRB. It is called as 1 upon CRR also you can call it as. So that is what is all about here. So this is with regard to the money multiplier. I hope this thing is quite clear to you. Now the next thing here you can see, we are talking about the monetary policy. I said you today we are going to discuss about the monetary policy tools. Now that monetary policy tools, they are very important for your prelims exams because one or the other question comes from there. So you have to be very specific, very clear with your basics. But before monetary policy tools, let's see that what is this actually monetary policy all about. So monetary policy is nothing else but it is the actions taken by the country's central bank. So that means whatever is the action taken by the country's central bank so as to manage and control the money supply and also the interest rate, that is what is called as monetary policy. So monetary policy, it is guided by the RBI. And why it is guided by the RBI? Because RBI is the apex bank, and RBI, it has to manage as well as it has to control the money supply as well as the interest rate. And the objectives with regard to the monetary policy, you can just see the headers. Price stability is one of the objectives. Yesterday in the last video I did tell you about that. Economic growth is also one of the objectives of the monetary policy, and also full employment is one of the objectives of monetary policy. So three objectives, that is price stability, and price stability can only happen when there is inflation. The inflation is under control. Economic growth can only happen when there is long-term investments which are done, and the long-term investments can only happen when the economy has favorable conditions. And who will create the favorable conditions in the economy? It is the RBI, it is the government and all. And then the last one is full employment, that is the monetary policy which is guided by the central bank. It always tries to encourage job creation, rather than unemployment and all. So it always, this is what is monetary policy. Now after monetary policy, I could say that the monetary policy tools which we are going to discuss today, the first tool, it is with regard to the CRR and SLR. Now this CRR and SLR, if we talk about the CRR and SLR, then very simple, remember it, CRR is the cash reserve ratio. Please don't go by the spellings. SLR is the statutory liquidity ratio. Now I'll give you a trick. What happens is that, very simply you can understand this, that there are deposits in the bank. Remember it, there are deposits in the bank. Now these deposits, they are what? They are collected by the bank. These are the deposits which are collected by the bank. And these deposits, when they are collected by the bank, then they are the liability of the banks. Okay? They are what? They are the liability of the banks. Why? Because the banks have to return these deposits. And when I say deposits, the deposits can be what? Demand deposits. The deposits can be time deposits. And in both these deposits, the bank has to pay back those deposits to the customers. Okay? So deposits are there. Now these deposits, as I said you, they can be what? They can be demand deposits. They can be time deposits. Now these demand deposits and time deposits, when added together, it gives you what? Total deposits. Am I right? Now when you subtract from these total deposits, interbank deposits, what I said? When you subtract from these total deposits, interbank deposits. Now demand deposit, I'm not going to explain you again, but you must remember, on demand, you can withdraw it or you can transfer it. Time deposits, it is for a fixed time, that is 333 days or 444 days or 5 years or 10 years, like that, time deposits. And on maturity, you can withdraw it, but if you withdraw before maturity, you are going to bear a loss. But when you add these two deposits, it becomes total deposits with the bank. But there are interbank deposits also. So when you subtract the total deposits with the interbank deposits, what do you get? You get NDTL. Now this is the new term for you? I guess not. NDTL is what? N stands for net. When in economics something is subtracted, then the word net comes. Okay? So net deposits and time liabilities. What did I say? NDTL is what? Net deposits and time liabilities. So this is what is NDTL. Now let's come to cash reserve ratio. So what is this NDTL? NDTL is nothing else but it is the total deposits when subtracted by the interbank deposits. So that gives us that NDTL. N stands for net, D stands for deposits, and T stands for time, and L stands for what? Liability, because all the deposits are liability for the banks. Now, what is the CRR? The CRR and SLR, they are completely under the control of the RBI. So it is the RBI who is setting the CRR and SLR. Now, if you talk about the present CRR, if you talk about the present SLR, you have to find that out. Okay, I'm giving you a work that what is the present CRR and what is the present SLR rate, that you have to know. But when I talk about CRR, then it is the percentage of NDTL. What did I say? It is the percentage of NDTL that banks have to keep with RBI. Okay? Percentage of NDTL that banks have to keep with RBI. So C stands for what? Cash. So C stands for what? Central. Just remember this trick. C stands for cash. C stands for what? Central. So this percentage of NDTL, the commercial banks, they are keeping with whom? They are keeping with the RBI. Okay? With the RBI. And this rate of the cash reserve ratio, it is being decided by the RBI, and for this, no interest paid by RBI. So RBI does not pay any interest. Now what is SLR? जैसे मैंने अभी आपको समझाया, like C stands for cash, C stands for central. So here statutory liquidity ratio, S stands for statutory, S stands for self. So this is the percentage of NDTL which banks keep with themselves. Okay? Which banks they are keeping with themselves. But they are keeping in the form of what? They can keep it in the form of cash, they can keep it in the form of government securities, and they can keep it in the form of gold. But maximum SLR which is kept by the government, that is in the form of government securities. Why? Because it is the most liquid and the most safest of all. ठीक है? It is the most liquid and most safest of all. So for you, this CRR and SLR is clear. C stands for what? Cash. So C will be referred to central bank. So it is the percentage of NDTL which the banks have to keep with the central bank, that is with the RBI. And for that, the RBI does not pay any interest. And the rate, it is decided by the RBI. So right now, I asked you, what is the CRR rate? It is as present, it is 3% currently. So you got the answer. Then the second one I said you, SLR. S stands for what? Self. So here the banks, they are keeping it with themselves. And when they are keeping it with themselves, it is in the form of what? Cash. It is in the form of GSEC, that is government securities, or in the form of, you can say, gold. But maximum SLR, they are kept in the form of what? Government securities, because it is very liquid and it is the safest of all. So that is what I have kept it here. Reserves in the form of SDTL, I have said you all of that. Then respective banks, they keep it with them, and banks, they earn interest based on the portfolio of SLR chosen. That means whatever is the portfolio of SLR the banks are choosing, on the basis of that, the banks will earn what? The banks will earn, you can say, interest. But CRR, only cash, and that is with RBI, and they don't earn any interest, the CRR deposit. So that is perfectly clear for all of you. Am I right? So if you have understood this, just give a thumbs up on the comment section. And I would request everyone that please, you can send this video to all those who are appearing for the, you can share this video with all those who are appearing for the Prelims 2026, and that would be very good of you. Okay. So let's go to the next topic. Without wasting any time, let's go to the next topic. And the next topic, it is with regard to the bank rates. Now, when I say the bank rates, then remember it, the bank rate is nothing else, but it is the rate at which the RBI, it engages in long-term lending. So the RBI here, it is engaging in what? Long-term lending. And this bank rate, it was established, we can say that whatever is the bank rate that was established in the RBI Act of 1934, but it holds limited relevance as of today. And here, no collateral is required. Remember it, there is no collateral required. And also, we can say that it serves as the foundation for penalty rate, that is the bank rate plus 3%, which gives you what? 3% to 5%, that is what is the penalty rate, if the banks fail to maintain the CRR or SLR. And then this is exclusive to banks for borrowing purpose, and it directly influences the bank's long-term lending activities and all. So remember that bank rates, they are basically long-term lendings of the banks. Okay? Long-term lendings of the banks. That is what is there. And no collateral is required in this. This is what you have to remember very importantly, that in bank rates, there is no collateral required. And it also serves as the foundation for penalty rate. So bank rates, they also serve as a foundation for penalty rate. That means you can say bank rate can be a base rate, and if the banks are not maintaining a CRR or SLR, then in that bank rate, the RBI can add 3% to 5% as the penalty rate. Okay? That is what. Then we are coming up with this liquidity adjustment facility. Now, before going into the liquidity adjustment facility, I should tell you about OMO. What is this OMO? All of you must be knowing about it. OMO is nothing else, but it is the open market operations. Now, in this open market operation, this is also, you can say, a quantitative monetary policy tool with regard to the RBI. When I talk about open market operation, in simple terms, in most of the books, it is written that the buying and selling of government securities by the RBI, that is referred as OMO, that is open market operations, because the government securities, they are all held by the RBI. So the buying, or I'm not saying and, it is buying or selling of government securities. Now, why I am telling all of this? Because I want to explain repo rate and reserve repo rate with regard to this. Now, open market operations, it is with regard to buying or selling of government securities. Now, when I talk about the repo rate, and when I talk about the reserve repo rate, now when repo rate or reserve repo rate is there, then there are steps which are being performed. First of all of you must know that repo rate, it is also referred as what? Repurchase agreement. So I am using the word what? Agreement. And this repo rate, we can know that it is for a specific rate, and that too for, you can say, specific rate ke liye hai. And right now the repo rate is 5.2% as such, all of you must know. Now, what happens in the repo rate? Repo rate, I said you, there is an agreement. That is agreement between whom? Between the bank and the RBI. So what the step one is that in the repo rate, remember, just listen to me properly. In step one, the bank, they are the owners of the government securities. Now, when banks, they are the owners of the government securities, then what happens is that the RBI, what it does, it pays, for example, take it as 100 rupees. That is, it is paying 100 rupees and it buys the bonds. That is, the banks, they are the what? They are the owners of the government security. And the RBI, it is paying 100 rupees and it is buying the bond. And when it is buying the bond, then what happens? That particular step, due to that step, liquidity is injected into the banking sector. Now, this liquidity which is injected into the banking sector, liquidity injected means money supply बढ़ जाता है. So, when there is liquidity injected due to this first step, when the RBI buys bonds from the banks, but this buying of bond is only for a fixed duration, short duration, for example, like 7 days or 10 days or something like that. So this induction of liquidity into the banking sector, that is for a short duration. So in the first step, the banks, they are the owners of the government securities, and the RBI, it pays an amount, for example, 100 rupees, and it buys the bank, it buys the bond. Now, what happened in the step 2? The transaction gets reversed. Now, why there is a transaction which is getting reversed? Because there is a repurchase agreement. There is a repurchase agreement between the bank and the RBI. So when this transaction gets reversed, then what happens? After some days, that is, for example, after 7 days, what happens? The banks, they repurchase the bond from the RBI at a higher rate, that is, for example, 110 rupees. So that is what is repurchase rate. Okay? That is what is repurchase rate. Okay? So, and this repurchase rate, It's also referred as Liquidity Adjustment Facility, LAF. It's also called as what? LAF. And this repurchase agreement, I said you, the repo rate, it's also referred as, you can say, the policy rate. Okay? So the RBI at a the RBI, it what to say, at a repo rate, it you can say it sells or it buys the government securities or bonds from the banks, and then that transaction gets reversed. And what about the reserve repo rate? Now, reserve repo rate is what? Here, the first step is where the RBI is selling. The first step is what? The RBI sells the government securities and the banks pay for it. And the banks pay for it. And then in the step 2 is what? That is the RBI, they purchase from the banks. Okay? And they give the banks a rate. For example, here the RBI, it purchases at, for example, 110 rupees, and banks, they repurchase at what? Sorry, this is 100 rupees and they repurchase at what? 110. But here the RBI, it sells at the rate 100 rupees. Okay? And we can say the RBI, it's selling it. And what happens is that the RBI repurchases at the rate 106 rupees. So always remember, like for example, repo rate, if it is 5.2%, 25%, repo rate will be lesser than that. Like for example, at present it is 3.35%. So this is quite clear to all of you that what is the repo rate and what is the reserve repo rate. Is it clear? So once again, I'll tell you both the things. Yeah, yahan pe what we are seeing is that there is buying or selling of government securities. So when there is buying or selling of government securities, then we can say that this repo rate and reserve repo rate, it is a part of this open market operation. But here in this repo rate or reserve repo rate, there is an essential agreement between the bank and the RBI. In repo rate, it is the bank which have to repurchase from the RBI. And in the reserve repo rate, it is the RBI which has to repurchase. Here, it is the banks who sell the bonds to the RBI at a price and they repurchase it at a higher price. That is, for example, 110 rupees. And here, the RBI sells the government securities to the banks, and the banks, they buy it at a price, for example, 100 rupees, and after a fixed time, fixed day, that is, for example, 7 days, the Reserve Bank, it repurchases this government securities at a price, but not as high as the repo rate. So it is like 106 rupees. So that is what is here with regard to the liquidity adjustment facility. You can just stop the video, pause the video, and you can write the details about here. But actually, I have explained you with regard to here. So open market operations we can say that when there is essential agreement which is involved between the bank and the RBI, that is with regard to the repo rate and reserve repo rate. So when we talk as reserve repo rate and repo rate, then they are a part of what? Open market operations. Now, open market operations can also be done as outrightedly. Now, when there is an essentially agreement open market operations, when it is with regard to essentially agreement open market operations, that means with regard to LAF, this is LAF open market operations. Then here the reserve rate and the reserve repo rate and the repo rate are involved. And here there is an essential agreement which is there between the RBI and the banks. And here there are two steps which are being performed. That is, there is a selling and then there is a repurchasing. That is what is involved here. But when we talk about outright open market operation, when we talk about outright open market operation, then in outright open market operations, the RBI, they will only sell or they will only buy. That is, RBI only sells or only buys. That means there is no agreement here. There is only buying of government securities or only selling of government securities by the RBI. So here there is two transactions involved. Here only one transaction is involved. That is either buying or selling. But here once buying takes, then there is a repurchase. Or once selling takes, then there is a repurchase. Okay, then here we can say that is there is no repurchasing agreement or there is no repurchasing order, but here there is repurchasing agreement. And here there is no repurchasing order. Okay, there is no repurchasing order. Okay, got it? And here the money, it is for long duration. Remember it? Here money, it is for long duration. That is long duration. But here the money, it is only for short duration. That is for 7 days or 10 days, whatever is the time which is agreed upon, that is what is there. Okay, so this is what is the difference. That means there are two open market operations. One is the outright open market operation, you should know about it. And the other one, it is the LAF open market operations. LAF open market operations, short duration. Outright open market operations, long duration. Here two transactions are taking place. Here only one transaction is taking place. Here the one transaction in the sense RBI only either buys or it sells. Here there is a repurchase agreement between the two parties. Here there is no repurchase agreement between the two parties. Okay. Now, let's talk about one problem which can arise. And that problem is that and this problem is with regard to the reserve repo rate. Now, reserve repo rate there is one problem, and that is if the banks, they want to keep more deposits with the RBI, but the RBI does not have enough government securities. That means the banks, they are willing to have what? They are willing to have more deposits with the RBI. And the RBI, it does not have what? It does not have enough government securities. So what will happen? So with regard to this, what happened was that a new facility came up and it was referred as standing deposit facility. Now let me tell you. Now this standing deposit facility, all of you must remember, this standing deposit facility as a monetary tool, it was introduced by the Urjit Patel Committee. Introduced by whom? Urjit Patel Committee. Now the surprise question to you. The surprise question is, during who was the governor of RBI who appointed the Urjit Patel Committee? Okay. So who was the RBI governor who appointed the Urjit Patel Committee? Number one question, write it down. Who was the governor of RBI who appointed the Urjit Patel committee and when? Number one question. Number two, what were the other, write it down, what were the other committees which were appointed by that RBI governor? That means the governor who appointed Urjit Patel committee, what were the other committees appointed by or formed by that RBI governor? The names of those committees you have to tell me, and what were those committees focusing on? Yeah, what were their recommendations? You have to keep in mind. So in the next video, I'll be giving you the answer for this. But now our discussion is that the RBI does not have enough government securities, and the banks, commercial banks, they want to keep more deposits with the RBI. So in that case, the Urjit Patel committee, it introduced a monetary tool, and that monetary tool, it was referred as standing deposit facility. What it was known as? Standing deposit facility. Okay? And in this, there are steps. Now here, step one, what will happen? The banks, they will deposit money with RBI. Banks, what they have done? They have deposited money with RBI. But here the RBI does not provide any collateral. Remember it. Whatever money the banks have deposited with the RBI is not providing any collateral. Now what the banks do? The banks, they can withdraw the money along with the interest rate. Got it? What is SDF? Whatever amount of deposit the bank made with the RBI, and the RBI does not have to give any collaterals for that, does not have to make any collaterals or provide any collaterals. So what the banks can do, they can withdraw the deposit along with the interest rate, and that is what is called as SDF, that is standing deposit facility. And this standing deposit facility, very important for your prelims, it's available throughout the year. Remember it, it's available throughout the year. That is what, which is very important. You can read it this, the banks can deposit any amount overnight with the RBI at a repo rate minus 0.2%. That means whatever will be the repo rate, usme 0.2%, 5% you have to subtract it. This rate, it is subject to change. And the SDF, it eliminates binding collateral constraints on the RBI. I said you, RBI does not have to provide any collateral. As a result, what happens? It functions as a financial stability tool along with its role in liquidity management. That means at one point it is providing liquidity management, at the other point it is doing financial stability. Now SDF, it is available at the discretion of the bank. That means it is available at the discretion of the bank. It is accessible every day of the week and throughout the year. So that's why I said it is available throughout the year. Got it? It is available throughout the year. And repo rate and reserve repo rate, they are at the discretion of the RBI. But SDF, it is at the discretion of the banks. Remember it. This difference you can find it out. SDF, it is at the discretion of the banks. Got it? Now, apart from this, there is one more, and that is marginal standing facility. That is MSF. Now, marginal standing facility, what happens is that a bank is in very emergency need. That is, there is an emergency which is faced by the bank. Now, whenever an emergency is faced by the bank, then the banks, they are allowed to borrow for short duration, and that too under MSF. That means MSF is nothing else but the banks, that is the commercial banks, because there is emergency which has come out, and because of that emergency, the MSF tool, it basically allows the commercial bank to borrow money for short durations, and this is also available throughout the year. And when it was introduced in 2011, okay, and the commercial banks to borrow additional overnight fund, that is additional overnight fund from the RBI. And always remember, emergency funds can never be lower than or equal to the repo rate. They will always be higher than the repo rate. So this MSF rate is always beyond the repo rate, higher than the repo rate. Okay? So that is what is the MSF. So MSF, always remember कि banks can borrow in emergency situation. Okay? The banks, they can borrow in what? They can borrow in the emergency situations. And the repo and the rate at which they are borrowing, that is always higher than the repo rate. And at present, the MSF, it is 5.50%. It is what? 5.50%. That is, repo rate is 5.25. So plus 25, that is 5.50% that you have to remember. And also one thing I must remember here, that I did tell you something about the bank rate. Now this bank rate, always remember, it is also referred as what? It is also referred as the lending rate. Okay, so till now CRR, SLR, then we also talked about open market operations. Now in that open market operations, I talked about LDF OMO and I talked about outright OMO. Now LDF OMO, why it is a part of open market operation? Because open market operation talks about buying or selling, and LDF also talks about buying or selling. But here there are two transactions, and in outright open market operation there is only one transaction. Then we also discussed about the standing deposit facility. Now this standing deposit facility, we can say that implemented in April 2022. I gave you a question. This was with regard to the Urjit Patel committee. Now I said you who was the governor of RBI at that time and what were the other committees he had formed and for what purpose he had formed. You have to talk about that. Then I also talked about the MSF. Now I have a slide for long-term repo operations. You can go through it, long-term repo operations. Now long-term repo operations may, what happens? The RBI lends to bank at the repo rate limited to the bank's net demand and time liabilities for overnight. That means whatever is the bank's NDTL. Now according to the bank's NDTL, the RBI is lending to the bank at the repo rate. So this is all also on the discretion of the RBI. Okay? So it is on the RBI's discretion that the RBI, it offers long-term lending at or above the repo rate, and that is determined through auction. So this long-term repo rate, it can be above the repo rate or it can be at the repo rate. Everything else is at the discretion of the RBI, and the RBI, it can extend long-term lending because the word long-term repo operation is there. So it's long-term lending is there, and this long-term lending repo operation, or if more banks seek fund, then the interest rates will what? Rise. Matlab, more the banks will try to have funds, but the more and more banks, if they will try to have funds, then the interest rate will rise and the competition will what happen? And if competition is low, then what happens? The interest rate will be low. So if greater the number of banks, then the interest rate will be high. If less is the number of banks, then the interest rate will be low. Okay? And collateral of government security is required but may not be 100%. Got it? So this is what we have done. Open market operations, I did tell you, outright and all. And what are the type of securities which are there with the banks? There are government securities. Now these can be short term, long term and interest rate. Short terms are like treasury bills, cash management bills, and long terms, which are for more than 1 year, sovereign bonds, then GSEC and all. And also there are corporate securities. Okay, now with regard to this is what we have to do. So now what we will do is that this particular video I'll pause here, and we'll meet in the next video where I'll be talking about the very important topic which I said that I'll be discussing with you, and also that is something with regard to your monetary policy framework, and also the monetary policy committee, and also the decisions which the monetary policy committee took in the February meeting of 2026. Okay, so please give your comments with regard to this video. Hope this particular session in which we discuss the monetary tools, you must have all understood. And I would request everyone that if you have not joined the Drishti YouTube channel, then there is a subscribe button there. You can subscribe the channel and you would get this particular 100 most important topics class out here. And if you are already a subscriber, then what you have to do is that you have to share this video to as many individuals as you know who are appearing for the 2026 prelims exams. Okay, thank you all and meet you in the next video. Till then, goodbye. Have a nice day.
For more informative content, like, share and subscribe, and do not forget to press the bell icon to get the notifications.